Welcome to the Merk webinar. Today's topic will be on the implications of midterm elections in the U.S. On the line, we have Merck's President and Chief Investment Officer, Axel Merk, and Senior Financial Analyst, Nick Reese. Before we begin, I would just like to announce that Axel will be holding an investment discussion and race on October 20th in beautiful North Carolina, and more on that from Axel in a bit. At the end of today's presentation, we will have a Q&A. As always, we do encourage questions from the audience, so please feel free to ask a question at any point during the presentation by typing it into the questions box on your screen. This presentation will be recorded, and with that, I will now turn the call over to Axel to begin the presentation. Axel?
Thank you, David, and welcome everybody. Today's topic is the midterms and what it means in the context of the markets, our or your portfolios, and portfolio construction, the sort of risks and opportunities. And as we look at that, the question is, of course, why do we care about elections? Do we all kind of know what the outcome will be? Maybe, maybe not. Nick Reese, our senior financial analyst, in a minute will walk you through several slides as to what the market thinks is going to happen with the specific election outcome. And then I'm going to give my flavor in the context of where I see the economy, what I see at the Federal Reserve. The FOMC is meeting tomorrow. And then, of course, relating that to the extent possible to our crystal ball on the markets. And of course, a big thing, since this is politics, is the impact on policy, how policy will be shaped going forward. So with that, I'll pass it on to Nick, and he'll cover several slides, and I'll chime in on some of them on the election specifically. Nick?
Okay, thank you, Axel. Well, here on the first slide is a table showing the past 100 years of data for midterm elections. So that would be 25 elections, and they're in chronological order, starting with the present there at the top in yellow, which is a question mark. We'll see how the election turns out in November. But what's being measured there in that left column is the percentage of House seats that are gained or lost by the president's party. And what you can see is that it's very normal for the president's party to lose representation in the House in midterm elections. And the reason that we focus on the House compared to the Senate is that the House, all House seats are up for re-election every 2 years, whereas you have this rotation in the Senate, which are 6-year terms. So 23 out of 25 of these past 25 midterm elections, the president's party lost a certain number of seats, with the average being a loss of about 12% of the seats. You can see the average at the bottom there. So with the Republicans currently holding 236 seats, which is about 54%, it would be very historically normal for the Republicans to lose control of the House. If they lost the average, that would be about 43 seats, bringing the Republican seat total to 193 and the Democrats up to 242. One thing to note is that the analog for Obama's first midterm, which would be 2010, the percentage loss of seats there was about 25%. Obama's approval rating, according to Gallup poll going into that, so in September of 2010, was about 45%. Trump's right now a little lower than that at 40%. So, a loss between, if that's any guide, a loss between the average of 12% and that analog of 25% might be roughly what could be expected.
And just in case you can't memorize all of this, we do make the PDF available of this. And so if you want to have a PDF of the slides, please drop a note in the Q&A box, and we'll make sure that you get one. Nick?
All right, thanks. So here we have the Real Clear Politics website that's pretty popular. I'm sure many of you have heard of it. They produce these poll averages, which are a nice way of getting a good overview. And so, the Gallup poll would be one of the polls that goes into this average. But basically, the disapproval average is the red line that's on top. That's 53%. The approval average is the green line on the bottom, 44%. That's in part to explain, I think, the subsequent slide, which shows the spread between those two. So yeah, so we have that here. So that's just, this is just the way I prefer to look at it. It shows the approval minus disapproval. So it's -9 right now. When the president came into office at the beginning of or mid-January 2017, it was he had a slightly higher approval rating than disapproval rating, so that was a positive number. The high was 4.3. It's been as low, that spread has been as low as -21, and now we're at -9. So this is a way of kind of just tracking the sentiment on the president, his job approval, and will be shown in later slides next to some market prices, the dollar index and the 10-year yield, and I'll get to those, discuss those more when we get there. But that's just to sort of introduce this concept. All right, then there are some predictions markets that are very interesting to track and very informative to follow. So this data comes from Predicted, which is a platform where you can actually, this is all determined by real money, real bets being placed on the essentially the odds of certain events taking place. So it's either going to be a 0 or a 1, and you buy these shares for certain pennies on the dollar. So right now, the chance that the Democrats take control of the House, which would mean a majority in the House, is priced at about a 65% chance, and the chances that the Republicans maintain control of the House, in other words, maintain a majority in the House, about 35%. And I think that's just from the prediction market, so it's a great cross-reference to have. I went through the historical table. I think maybe the chances are a little bit higher that the Republicans lose control of the House. Maybe in my mind that would be more like an 80% chance. But this gives us an idea of kind of what's being priced in by the markets in some sense.
And just maybe 2 comments on that. One is we are not encouraging anybody to quote unquote bet in these markets. And also, as Nick points out, a lot of these bets are pennies. These are small bets that take place, and these markets, one can argue how efficient they are. So they are their guide point, their reference point. But this is not the amount of certainty you put behind these numbers is up to you. Yet you do see some trends, of course, in these numbers, and this is very consistent, I think, with the typical losses. Just as a background here.
Right, then turning to the Senate race. So as I mentioned earlier, the Senate's a different story because you have this rotation of which seats are up in any given election. And the way it's configured, the way these seats happen to fall this year, actually the Democrats look a little bit more vulnerable. They just have more seats up for re-election. That being said, looking at the polls, it seems like it's pretty, like many of those seats are going to be, held by the incumbent party. And, so it's likely that the Senate will remain very similar to the way it is now in terms of the split, which is right now 51 Republicans, 49 Democrats. That's in the 100-seat Senate. And, maybe the Republicans, according to, the polls and just the breakdown of which seats are up for re-election, maybe the Republicans on net might pick up a seat or two. But, that's sort of a base case scenario with a wide, range of what could happen around that central scenario. One thing to note, just for out of interest, because a lot of things going on that are getting attention, but one thing is that it's very likely that Mitt Romney will win the Senate election in Utah. He's likely to take over Orrin Hatch's seat, who's retiring, and so we'll see Romney's name in the news likely more after this election.
And just one broader comment, I'm going back here to the House race chart. Keep in mind that this is not just priced into the betting markets, but since this is historically common to the extent that Democrats do take the House, one could make the argument that's priced into the markets. Now, clearly, whenever an event happens, then you look forward as to the next thing that will happen, but it shouldn't come to a huge shock to the market if the Democrats do take over the House. Nick?
Yep. Then turning to, so this is again from Predicted. There's a betting market on the percent chance that Trump is president on December 31st, 2019, so the end of next year. So that's the event where it's either a 1 or a 0, and here is the basically where the market is priced. So 67 cents on the dollar, so 67% chance that being priced by this betting market that Trump will be the president at the end of next year, which is clearly before the first term is up. And so this is in some sense a gauge for market expectations around, this could be for any, out of office for any reason, could be a health issue or something like that. But but I think the main thing that people are focused on are the chances of a possible impeachment, which is certainly, as we went through the numbers, it's certainly likely that the Democrats will have a majority in the House, and all that's needed for impeachment is really just the step that is, bringing this trial to begin, and then ultimately there would be a trial, and the Senate would have to have a 2/3 majority in order to remove a president from office. But the act of impeachment is the simple majority in the House, and the Democrats will have that. I think a couple of points that I want to make. One is that the Democrats, I think, need to think about what their goals are, what their priorities are, and what their strategy ought to be. I mean, if they are successful in impeaching Trump, or in fact removing him from office, then they would almost certainly be running against a President Pence in the 2020 election. And there's a question from a strategic standpoint whether the Democrats would rather run against a President Trump or a President Pence if they want to win the 2020 election. The other thing is that if you look at the numbers in the Senate, let's assume that the Senate is going to stay roughly the way it is now with 51 Republicans, which is a majority. In order to remove a president from office, you'd need a 2/3 majority. That would mean that you'd need all 49 of the Democrat votes plus 18 Republicans to vote for removal, which is certainly possible. But Trump's polling numbers are very high in terms of his job approval rating among Republicans. So the latest Gallup poll has his approval rating at 87%. It's been very stable in the mid-80s since he took office. The lowest it's been is 77%. So as long as his approval ratings are very high among Republican voters, it would be very, I think, politically dangerous in terms of the future careers of these senators who are going to, potentially, vote to remove Trump from office. And as I said, I don't even know that that's what the Democrats ultimately want to do. But let me pause there for a second. Maybe Axel, you want to comment on that?
Well, the only comments I make is in the context of what you just said. I do think that the 67% survival chances might be on the low side and might be driven by the nature of this particular prediction market, that the folks who want to see him removed from office might be more willing to take bets there than otherwise, because I do think that the odds of the Senate going along with the House are fairly small. The only kind of little difference I have maybe in Nick's assessment is that, yes, if Trump were to remove from office, obviously Pence would step in. I am not certain that Pence is necessarily then the candidate in 2020, but obviously that's one of the scenarios to be considered for the Democrats.
Yeah, then coming back to, as I mentioned earlier, showing Trump's, the spread in his approval rating, which is in gray there. So that's the line that we looked at earlier. And then this is shown against the dollar index. Seems to be some loose relationship there, possibly. Don't want to overinterpret this chart, but it seems like both this chart and the following chart, which shows the U.S. 10-year yield, seem to suggest that the more Trump is, the better his approval rating is, the more likely that some of these pro-growth policies might go through, and therefore, we'd see the inflation or real growth effect of that, which could be getting priced into the 10-year yield there.
So the one comment I'd like to make on that is this relationship, especially to the dollar, was quite a bit in the news during the tax reform, and I think for good reason, because the tax reform has a real impact on the long-term growth impact. I'm switching here between the slides of the 10-year and also his approval rating. When you had the higher growth prospects potentially due to the growth due to the tax reform, then there was a reason for more optimism and so forth. And so, to the extent that the odds of passing tax reform were higher, I do think that there was a good argument to be made how that relationship was in place. I'm not so sure whether the relationship between his approval rating and the dollar or the 10-year is necessarily going to hold true, simply because of the lack of legislative agenda that's currently in the pipeline. I'll talk about that more here in a minute. Actually, I'll talk about it more because this, I think, Nick, did you want to have any more comments?
Yeah, maybe just a couple more comments. I mean, one thing that I haven't stated explicitly, but obviously, assuming the Democrats take control of the House, that would certainly slow down any legislative agenda that the president has. Typically, you're trying to get everything done when you have control of both houses in the first half of the first term. In this case, so to echo Axel's point, probably going to see less action in terms of policy changes. And then just one point on the potential for, Trump to be removed from office. If we did get a transition from Trump to Pence, it would be, I think, less of a policy impact than the changes that you get from one party to another. So less than the policy impact from Obama transitioning to Trump. So from an actual policy, I mean, it would be a major, of course, historical event and news item. But from an actual policy standpoint, I'm not sure how much that would actually move the needle.
Yeah. So the reason I know, thank you, Nick. I move now to this picture of these two lovebirds, is to make a point. It is historically very common for a president to vote without having Congress be in the same party. I mean, there's a reason why the last time there was a significant tax reform was during the Reagan era. It's just that easy to get things done. You have an executive branch that's quite powerful, but the executive branch is powerful in executive action, not so much necessarily on the legislative side. The president obviously cannot pass laws. They do drive the agenda, the legislative agenda, but only to the extent that the party goes along or that they're sufficiently charismatic and diplomatic to get things done. And one of the things that folks who did not like Obama criticized of him is that he was regulating a lot of things without the legislative endorsement, so to speak, that he was ruling from the executive branch. Well, guess what? That is what presidents do when they do not have the majority. So similarly, President Trump does the same thing. He is executing executive orders to the extent that he can, and to some extent they get challenged in court. And to the extent that Democrats will win the House, I would think we'll see more of that. And we already saw that, the one big legislative piece that Trump did get through Congress was the tax reform. And so almost everything else has been done on the regulatory side through executive action. And of course, the areas where you can do things on the executive side, they tend to be on regulation and on trade, foreign policy. And there is obviously an argument to be made what things the Congress has to agree with and what not. But I do think kind of just if one takes away the persona Trump that raises lots of emotions in people, in some ways on the legislative side, in the regulatory side, it is not as extreme as some people might want to think it is, simply because we have seen this before. Clearly, the way this is all being communicated might be a new era, and I'll talk about that here in a bit more. I do want to make a point here on an issue that the executive branch does have an influence on, which is trade. And I have here just these two placeholders for the winners and losers. And the winner in a trade war is, in my view at least, the government. And in the sense that when you initiate these trade tensions, what you really do is you're igniting the kind of the motivation of lobbying groups to lobby in favor of having things go their way. And so you see that also in political donations being ramped up in industries that are particularly affected by trade disputes. And so those who think that the swamp will be drained, I have news for you. That is not the case, because this is politics as it has always been. So you talk up a trade war to score political favors with your base. That's what politicians do. Obama did it, Clinton did it, the two Bushes did it, and it is politics as usual from that point of view. The big loser in this is small business. And the reason I say small business is that if you're a small business engaged in trade, you might be whacked by one of those policies. If you're a big business, you have two things going for you. One is that you have the depth and the resources that you can change the way you do business, and you can work with these the new regulations. And then you saw the announcement a few days ago on Apple being exempted, for example, on tariffs imposed on China. And we're not making investment recommendation here on Apple, but that's the sort of thing that happens when big business is in the crossfire. They get an open ear, they can talk, and they might be able to achieve an exemption. Whereas if you're a small business and you export a particular item, then that's difficult. And if you take, just more broadly speaking as well, if you're a smaller business and let's say you're involved in steel, and especially if you're involved in the trading of steel, the price variations can be rather dramatic. And so that basically means that you might be making lots of money one day, depending on the tweet or depending on the message, but then you could be out of business because you bought an inventory that's way overpriced, and because there's a resolution or something, there is a change that's not so happy. Now, just my own view on all of this is that if you want to improve the trade balance, you should not have the government micromanage those sort of things. You should provide other incentives that encourage manufacturing and things like that. And the tax reform, by the way, does go a long way for that. Beyond that, a lot of this is politics. Now, one of the things, of course, many people have noticed is that the markets have shrugged off a lot of the things that have been happening, and there are some reasons for that. And I think the key reason, the most important reason, may well be that the tax reform is overwhelmingly more important than what's happening on the trade side. Now, that doesn't mean trade doesn't have the potential to kind of take on a far bigger dimension and potentially be very, very destructive. Keep in mind, though, that the Chinese have been positioning themselves as the grown-ups in the room, and they have not retaliated on a big fashion. And so at this stage, this is mostly considered to be the Trump style of doing things. So, and with this said, let's go here and put this a little bit into context of where we are in the economy. And if you were very concerned about a trade war, you would think that people will invest less, and there's going to be a lot more pessimism that's out there. Yet, I'll show you some slides here where we are here in the economic cycle. Part of these, by the way, are some of these slides you see in our research slide that we publish at merkinvestments.com/research. We have chart books on the business cycle, on interest rates, on the equity markets, and a few other items. And you can look up some of those chart books there. But based on the leading economic indicators, we're doing just fine. We've kind of leveled off here at a very high level on the year-over-year rate. And so overall, there is a positive perception in the market of where we are. And that is backed, obviously, as you know, by a labor market that's very strong. And I'll show you here some different perspectives of looking at it. These are the initial and continuing claims in over the long term. And keep in mind, the population of the US has grown significantly, and these are absolute numbers. And so we have a very strong economy from that point of view, which to me, of course, raises a question, is whether we have exhausted the labor pool that's available to join the workforce. And this is an indicator here. We call it the market labor slack indicator. I don't think our Fed chair calls it as such. But what this is that this is the labor force participation rate amongst the prime age males. And so these are the men in their prime productive years. And the reason we focus on the men only is because you have fewer distortions of what you've had over the years of women joining the workforce or being less in the workforce. And so it's a more representative picture, in my view at least, on people participating in the labor force. And there are various reasons for that. Increased social benefits, an easier way to go on disability, for example, has been one reason. If you have more or less of an incentive to be in the workforce. You'll be less likely in the workforce. The opioid crisis is quite likely a significant contributing factor, and quite relevant, of course, is that after the Great Recession here of 2008, the participation rate dropped, and it's been climbing. And I've indicated in the past that if we cross that long-term trend line, we may well have exhausted that labor pool. Now, keep in mind, this trend line here is just put in with hindsight. This is not a very scientific way of measuring it, but nobody really knows when we have exhausted that pool. We call it the Powell labor market slack indicator because we wouldn't be surprised if Powell, based on his comments, has a related view on that. And based on that, I figured by the end of this year, we might have pushed to this line. But of course, the latest data point kind of went the other way, that more people will be joining. And of course, that's the sort of this discussion that's happening at the Fed as well. How much more can you drive this economy without overheating? And now I mentioned this word, that the one thing I'm concerned about this economy is that it's going to be overheat. We have a monetary policy that continues to be accommodative. Interest rates have been going up, but we are still below what the Fed would consider a neutral rate. So we have the Fed on the accelerator, even if it's less than it has been in the past, with a fiscal policy that is expansionary, meaning that we have a tax cut that's a stimulus to the economy. We still have some money printing happening in other parts of the world, and we have this unemployment rate that's a very, very low rate. And so we get very excited about elections and what's going to happen, and is Trump going to get more support, or is he going to lose the House? Is he going to get impeached? Is it not going to impeach? Well, there's a school of thought that says all of that is a little bit of a sideshow, because what really matters is the economy. Now, clearly, the confidence and the consumer confidence matters. Consumer confidence happens to be very high. Now, if I look at Europe, consumer confidence had abated a little bit earlier this year, and part of that has been the threat of a trade war. And there, I'd like to mention, U.S. economy is much less dependent on trade than the European economy, for example. And also, the Europeans, in my view, haven't gotten quite used to how to interpret a tweet that comes early in the morning. Or it might not be early in the morning for European times. And so, talking about these inflationary pressures, let's look at that here from a different point of view. The unemployment rate that's commonly cited coming down, and this is as of yes, this is the August unemployment rate here. And then let's look here at wage inflation, and it's one of the hourly earnings here is one of the inflation indicators. And while these are clearly noisy data series, these things have been moving higher. And so, in my view, it doesn't take a rocket scientist to say that there is a significant risk of the economy overheating. Let's look at what the Federal Reserve is doing and has been doing. And this is a chart, I think it's unique how we present it. These bars reflect how much in Fed rate hikes is being priced in for 2018 and 2019 in percentage points. And so the most recent data point as of September 24 is that 2018 plus 2019 rate hikes combined, including the ones we've had already year to date, will be 1.41% higher at the end of 2019. And the idea here is to show that over time here, over that horizon since October 2017, an increasing number of rate hikes has been priced in. Indeed, last year, 2017, was the first year, and we don't go all the way back here on this chart to the beginning of 2017, but you see here this line has been moving higher. 2017 was the first year since the Great Recession that the number of rate hikes priced in at the beginning of the year was less than at the end of the year, meaning that there have been hawkish revisions, that the Federal Reserve had become more hawkish as time had moved along. And I think that is very, very relevant as to kind of the context of going forward. Will there be more rate hikes? Now, some people say, oh yeah, we're going to go to the neutral level and then we'll pause and that's the end of it. Well, that all assumes that inflationary pressures are not going to increase. And by all means, there's no guarantee that they will. The Federal Reserve doesn't see its role, the current Fed at least, to have a crystal ball that say, hey, this is going to happen. we have as a Fed chair a lawyer. And a lawyer to me means somebody who does not have an agenda on the monetary policy side. And I say that in the context that, remember Bernanke, Bernanke was a student of the Great Recession. He had very strong views on how to manage a situation like that. And then we had Janet Yellen, a labor economist, very strong view on the labor markets, in love with the JOLTS report. And I'm not suggesting one is necessarily good or bad, but Jay Powell, as a lawyer, he is agnostic in some ways. Now, he might be perceived hawkish a little bit, but more importantly, he is, as an intelligent person, is going to call a committee. He's going to ask people to give him the data and then to make up his mind. And what I'm trying to say with that is that he's going to be sluggish. He's going to be slow to react. He's not going to be a Greenspan who has a crystal ball and based on his perception on how this is all going to play out and saying, I'm going to tweak this a little bit and I'm going to be the maestro. The maestro days are over. We have a bureaucrat here who is going to manage things. And that means, and he has said as much, that he is going to be marching along unless something tells him to march in a different direction or do differently things. And we don't have it here, but if we look back at, I'm just checking ahead here on some slides ahead here, if we look at what is going to get the Federal Reserve to stop hiking, the one thing, the Federal Reserve's job is not, as we see here on, let me see to the next slide, is not to manage the steepness of the yield curve. The steepness of the yield curve is the relationship between longer term and shorter term yields, and as shorter term yields move higher, we can get what's called the yield curve inversion. The shorter yields are higher than longer term rates, and that's historically considered a dampener on economic growth and has usually preceded a recession. And I say usually because in some ways it's a necessary but not a sufficient conditions. Obviously, if you wait long enough, you always get a recession, but the red areas, the shaded areas here are historic recessions since the early 60s. And you can have a yield curve inversion of the yield curve without necessarily getting a recession right away thereafter. And there's a reason for that. The reason why you invert a yield curve as a Fed official is because you want to take the foot off the accelerator. You want to maybe apply the brakes precisely because inflationary pressures have been moving higher. The whole point, by the way, of hiking rates is to tighten financial conditions. And why else would you be hiking rates other than to potentially slow down the economy or taking away some of the juice that stimulates the economy, which is the same thing really. And what's been happening is that since mid-2016, as rates have been moving higher, financial conditions have not tightened, meaning credit is abundantly available. And obviously there are some exceptions here, most notably in emerging markets, but emerging markets is again not the mandate what the Fed has. And so with regard to the US, in early 2016 and late 2015, early 2016, we had the scare from fracking where financial conditions did deteriorate. Access to credit to the fracking industry was difficult. And guess what? The Fed backpedaled at the time. But as long as the markets are going along, the Fed is going to continue to march. Now, some people are saying, hey, let the stock market crash and the Fed is going to do a U-turn. Well, obviously, it depends a little bit on the type of crash, but the reason why people have the perception that the Fed is married to the stock market is because in the 2018 financial crisis, there was a strong relationship, but it wasn't so much the stock market, it was the access to credit that drove what the Federal Reserve was doing. So if you have a stock market correction of 10%, 15, 20%, or even more, that in itself is not going to get the hiking path to be immediately removed. And the reason I emphasize this so much is that this is very important as one thinks about how to position one's portfolio, how one goes about it. There is no Greenspan put, so to speak, with regard to the equity markets. There will be in my view, a Fed put with regard to availability of credit per se. But an inversion of the yield curve is not going to cut it. And also, in the context of an election webinar, an election is not going to do it. I mean, let the Democrats take the House. That's not going to change Federal Reserve policy. The one thing do keep in mind, though, and what can happen, is that if I am correct that this economy will overheat, that means at some point the Federal Reserve will have to slam the brakes, or even gently so, and that means there will be presidential suites that complain about higher rates. And some people have shrugged it off. It doesn't matter. Well, it does matter. And the reason it does matter is that the cheapest policy, the cheapest monetary policy, is a policy where the Federal Reserve can move the markets with words. And if those words get torpedoed by somebody influential, and I would allege the president is influential, then odds are that the Federal Reserve will have to do more to achieve the same thing. That either have to increase the rhetoric, or they actually have to hike rates more than they otherwise would. And so the first time that President Trump made these comments that he didn't like higher rates, guess what? The bonds sold off, yields rose on the long end of the yield curve, and to me, that is the rational reaction. And so by President Trump interfering with monetary policy, he is increasing the borrowing costs of the US government. And so let me just do, before I talk a little bit more about the election and then portfolio impact, show this one here. I didn't show the US PMI. They are doing just fine. The latest data point, which was a tad down. The latest data point was a different data series that many people look at than what we tend to look at. Overall, US purchasing manner indices look fine. In Europe, we've seen some slowdowns in some areas. Most notably here, you see Germany moving down, and you have Italy moving down here as well on this chart. Now, a few things, though, to be said about the Eurozone. I just mentioned that I see the potential for an overheating US economy. Well, what's going to happen if the US economy indeed does overheat? Inflationary pressures are going to increase. Well, the US may not be exporting all that much on the trade side, but the US will export inflation as well, at least a little bit of that. And that's not just my view. Draghi, the president of the European Central Bank, has indicated as much as well, that there is a potential of inflation moving higher due to that. Draghi has also indicated, and this is not new, that he has been saying that for some time, that European parliaments have, or governments have, expansive fiscal policies. So there is also stimulus from that point of view. And by the way, for those who don't remember, we have a monetary stimulus as well. Interest rates are negative, continue to be negative in the Eurozone. And so all of that suggests to me that in the Eurozone as well, inflationary pressures may increase. The official forecast for inflation in the Eurozone is 1.7% for this year, 1.7% for next year, and 1.7% for the year thereafter. In my view, that's absurd. It cannot be that low. And indeed, yesterday, Draghi spoke in the European Parliament, and some interpreted what he said to suggest that he thinks inflation will move higher. I happen to agree with that interpretation. And sure enough, the rate hikes priced into the Eurozone have also been increasing of late. Now, not dramatically so. What we're looking at, by the way, if in the US I'm focused on the 2020 interest rates, and maybe December 2019 interest rates in the Eurozone, I want to look at least half a year beyond that, as Draghi is retiring at the end of next year, and those rate hike expectations have been moving higher. Now, that's also coincided, by the way, and here you see the Italian PMI going down. Well, what's been happening in recent weeks is that the spreads of Italian debt over German debt, it's kind of one of the risk indicators in the Eurozone, has been coming down, meaning that the fear of Italy going off on doing something that's not compatible with European rules and picking a fight, those sort of things, or the market picking a fight, more importantly, with Italy, those risks have abated as Italy appears to be presenting a budget that seems to be very much a conformist budget. And so a lot of that optimism that's in that sense coming into Italy from the market's point of view, and through that allowing a higher rate hikes in the Eurozone, in my view, is going to be priced in. So we have things in the Eurozone not quote unquote falling apart. Indeed, there are many positive things on growth, despite here the taming interest, the taming PMIs. And then on top of that, I do see inflationary pressures pick up. And by the way, the one thing to worry about something is when nobody else worries about it. And a lot of people don't worry about inflation. And so let's circle back here to the election. You might recognize that a woman here on the lower left, that's Elizabeth Warren. And the reason I show her is I want to take a leap ahead to the 2020 election. And I'm not predicting that she's necessarily going to run. If she doesn't run in 2020, she's going to run in 2024. That's my view. But the reason I show that is to say that we're also glued as to what's going to happen in the midterm election, because of course that's the most important thing in the short run. Let's take a step back and think about the bigger picture, what's happening in the medium to longer term. In my view, the populist trends are not over. And we have populism not just in the US with President Trump pursuing popular policies. We have them in the UK with the Brexit policies. Prime Minister Abe in Japan is a populist prime minister. And as we talk today, Merkel, the anti-populist, I suppose, just lost she didn't herself lose a vote, but one of her allies has been voted out of being the parliamentary leader in Berlin, where there's change in the air as well, and some more populist political figures in Germany are also on the rise, not to speak of the more populist parties there as well. So populism continues to be on the rise. And if history is any guide, my take is that the public tends to veer to populism in one end of the political spectrum, and then when people realize that their standard of living may not be getting all that much better, they are perfectly willing to do a U-turn and embrace somebody at the other end of the populist political spectrum. And so what that means, though, is that, of course, from investment point of view, you might get more regulatory changes. Whether you get things done on the legislative side is going to be a story to be evaluated as we get closer to that. But for those who think that, oh, this is going to be over, and think about impeachment or this or that, the question is not when is it going to be quote unquote over. The question is always, what's going to be next, and what sort of policies can come with that. And so, and that's something to keep in mind as you do the portfolio construction. Now, I grabbed this simply as a placeholder. I'm not suggesting here that investors should put most of the money into gold, but since we do talk about gold quite a bit, I talk about gold here, and I'll talk about the portfolio more broadly. The first thing I wanted to say is that I've made, I think, the strongest point that rate hikes are going to be more than are currently priced into the market. You can actually take a position on that using derivatives, and I'm not encouraging here people to jump and pile into derivatives, but for larger investors, we can help you do that. So you can reach out to us if you want us to help you with that, either on the way up. One of the nice things about rates going up, if you do take position on interest rates, you can do something on the way down. In our view, when you reach the peak of the economic cycle, and by the way, that's why we publish a chart book on a business cycle to give some input on that. When you're at the peak economic cycle, we believe that the future rate cuts are not sufficiently priced into the market at that stage. And you don't have to be 100% precise on the investment. Of course, the higher you go, the more potential then you have to profit on the way down. That's why we spend a lot of time trying to research as to when do we reach the peak of the economic cycle. We just had an analyst report come across my email inbox that said this expansion can last another 3 or 4 years. My view is we're going to overheat. I do think there is a very significant risk that it may not last 3 or 4 years, that we might get the economic slowdown coming into the 2020 election. And then what, right? I like to remind you of this picture that I just showed you. We have an economic slowdown. We might have a president who's very unpopular. So you could have a jolt and have a very polarizing populist person to come in. And Mitt Romney is going to be too boring, right? He's not the type of person who comes in with all kinds of reasoning on prudent policies, if you like that sort of thing that he was preaching. He is not the sort of thing, he's not electable these days, I don't think, on the as a president, he's had his chance, right? And so there's a new generation, a more populist generation, and I mentioned Romney on the right there, of course, moderate folks on the left as well. I wouldn't be surprised if we have the economic slowdown come just as we are heading into the 2020 election. And of course, then you have a president who is not afraid of taking at least strong words. And so it's going to be interesting. It's going to be interesting. And the question is there going to be enough kind of ammunition, so to speak, to keep certain markets going? Inflationary pressures are increasing, the economy is slowing down. Suddenly the glass might be half empty. And so that is why it is quite important, in my view, to figure out when do we have the peak in the economic cycle. And of course, another way of looking at that is, well, historically, during economic expansions, risk markets, notably stock market, is doing much better than during bear markets. But different investors have different preferences, right? Do you want to go all the way to the peak, or when do you want to take chips off the table? And another way of looking at that, you don't have to be pessimistic on the markets to say, hey, maybe I should rebalance my portfolio. And those who have followed me for a while kind of know my view on that. I happen to think that if you have a traditional 60-40 portfolio, that 60 portion has gone to 70 or 80 because you let your winners run, you have not rebalanced. And so now what? Now you have a portfolio that has a higher risk profile than I believe that you wanted to have when you set it out. Not only is the equity portion likely riskier, on the fixed income side, if you have a 60-40 portfolio, many people have been chasing yield. Well, if you chase yield, you've been going out and pursued fixed income investments with either greater credit or interest rate risk. And the more risk you have in there, even if it's a latent risk that hasn't kind of shown its ugly head, the greater the odds are that it is actually correlated with your risk assets. And so I continue to believe that a lot of investors are overexposed to risk assets. And part of the reason is that it is so darn difficult in an environment where the stock market has just been going up and up and up and up to do something about it, right? And so the good news is that cash these days is actually yielding something. Maybe not if you have it in your checking account, but if you buy treasuries. That is a way to be diversified, right? But I would encourage investors to kind of look at their portfolio, whether they have enough diversification in there. And one of the, I've been quoted as gold being the quote-unquote easiest diversifier. Easiest because in the long run, it has a correlation of 0 to stocks. But of course, it doesn't go up every day. It's not always the best diversifier. It might be the easiest diversifier. And in the context of higher rates, some people are saying, well, why would I own gold when rates go higher? The one thing I'd like to mention, gold, with hindsight, has over extended periods has historically been a good investment. People just never know why this brick should be a good investment going forward. I'm almost sure we'll have that same discussion several years from now. Well, the way I see it, and I apologize for repeating myself for those who have heard me say this before, gold's biggest enemy is high real interest rates. So high rates in themselves are not sufficient. If real interest rates go up substantially, if you think that Paul Volcker is at the head of the Federal Reserve and real interest rates go up substantially, maybe not as extreme as in the early 80s, and then gold may not be the right investment. But in every stock bear market since the early 70s, when the price of gold has been allowed to flow freely, price of gold has gone up during bear markets, with the big exception of the Volcker-induced bear market. And so if real rates don't go up substantially, and in my view, a Federal Reserve that's just chunking along, is moving along as inflationary pressures build, that argument against gold doesn't hold water. And the other argument for gold is that I like to bring is gold does not have a cash flow. And that's a good thing when it comes, and that's the reason, one of the key reasons it does well in bear markets. In bear markets, volatility tends to go higher. When interest rates go up, the cost of capital goes up. The discounting of future cash flow through that goes higher. Well, gold doesn't have that cash flow, and so there's no greater discounting. And so that's, in my view at least, historically, when volatility has gone up, which is both can be a factor of general market conditions or of higher rates. Higher rates should cause higher volatility in my book. That is one of the reasons why gold is a good diversifier, even as rates is moving up. Now, I just mentioned that interest rates moving higher should cause more volatility. It should do much more than that. The whole point of quantitative easing had been to compress risk premia, to keep volatility low, to make the perceived risk of investments appear lower. I say appear lower because, of course, investments were still risky. And as we move towards quantitative tightening, the European Central Bank is expected to be phasing out its printing as well by the end of the year. Risk premia should rise. That means volatility, all else, should be moving higher, and everything else, prices should be lower. And obviously, when earnings move higher, that is not all else. So if earnings move sufficiently higher, equity prices can still do well. But the one other side effect of risk premium moving higher is that active management should also benefit from that. When risk premium is higher, when you have a greater dispersion of risk, then you should also have active management be able to discern the winners and losers. Now, I have to mention currencies, of course, since we do manage a lot on the currency side. Again, the reason why we love currencies so much is because the currency space allows you to construct portfolios that are non-correlated to the to risk assets. You can go long short currencies, for example, and so we see a lot of value in that. You can do long short equities. You want to, in an environment where it is difficult to get a fixed income investment that you like to have in a portfolio, you might want to look beyond that. And we think that the currency space is a way where we can do it. So now I've talked a lot. Let me do one thing before we open it to Q&A. David mentioned it in the beginning. On October 20th, I will be in North Carolina. Now, I know most of you are not located in North Carolina, but please come and visit North Carolina. I'm doing two things. I am doing an investment conference with Mark Yuskro, and he is of Morgan Creep Capital Management. I challenged him on Twitter to, quote unquote, walk the talk. We have several interesting investment topics to discuss. And we will not just walk the talk, we will, quote unquote, run for the money. Those are some Twitter hashtags we're using, and do a little race the next morning. There's a half marathon and a 5 miler. This will be a great weekend. If you are able to, join us and drop us a note if you haven't seen anything on that. Come in your inbox. But we're also raising some money for a good cause. But the point here is, let's have a good time. Let's discuss global threats and opportunities. Let's have an investment discussion. Let's have some fun. And yes, for those who can, then the next morning, let's also do a little bit of running. David, I'll pass it to you to manage the Q&A.
Great, thanks, Axel. So please now take a few minutes to read the following disclosure on this next page as we move to the Q&A portion of the call. Again, I would just like to remind everyone you can still ask a question by typing it into your text box. Our first question comes from Mike Wind, and he asks, do you think that real interest rates reaching 1.5% is significant? Is it true that money will go from stocks into bonds at that level? And would this be related to the start of a bear market? Axel?
Well, if you knew the one trigger point as to when the money would be shifting, that would be too easy, right? And that's one of the reasons why I encourage people to have a longer term plan, and people's risk preferences to kind of time the top precisely might be different. We have seen emerging markets shake a little bit, and that's kind of the first sign that the higher rates in the US have an impact. But we haven't seen that spillover, so to speak, into the US. And we still have that amazing stimulus that's coming from the fiscal side, overwhelming, in my view, the headwinds caused by the trade uncertainties. And so at some point, yes, the high interest rates might be blamed for a stock market that goes down. But I would see it more in the context of the economic cycle. The economic cycle at some point is going to peak. And that's then at the latest when I think people will see the glass will be half empty. But it's not going to be like a switch where suddenly things move down, right? You see for example, we've had increased rhetoric against social media company, and since they have been a market leader, well, maybe they'll drag stocks down, and then things will topple. And at first it was company specific, and then suddenly it's broader. And then I assure you that with hindsight, we'll have a storyline that fits it all. I'd be reluctant to put it all into kind of one number, such as real interest rates. And if you just take real interest rates, there's also a dispute on how to measure that precisely. And so from that point of view, I'd just be reluctant to look at any one metric. We try to look at many different ones. David?
Okay, our next question comes from Chris Roth. The question is, given that markets have seen new highs recently, does this bode positively for markets, or is the risk of a major correction elevated? Axel?
Well, maybe it's just the audience I'm attracting, but people tend to be concerned about at the peak of the markets. I've actually been less concerned in recent weeks than I had been in a while. And part of that is because I continue, overall, we have a chart book on US equity markets where we show different ways of looking at market breadth. And the breadth has been doing all right. There's somebody on Bloomberg mentioned this morning that the stock market reached an all-time high as measured in the S&P 500. But if you look at the equally weighted S&P 500, you also reach an all-time high, and even the reverse weighted, where you weigh the smallest companies, the biggest, that it reached an all-time high. And Nick, maybe if you're on the line, you can chime in as whether that's accurate. I didn't do a fact check whether that happened in the recent days as well. Are you still on there, Nick?
Yeah, well, certainly the equally weighted index, I can confirm, also made a new all-time high when the S&P made the last new all-time high close, which was last Thursday.
Yeah, same. And so from that point of view, breadth is still up there. Now there are some medium-term concerns, and one is simply one of autocorrelation. We have one chart that goes back many decades that shows how much money is in equities versus bonds, and obviously when somebody sells a stock, it's not that stock disappears, then it's just the price that changes, but the value of equities versus bonds out there, the equity portion is quite high, and historically speaking, that suggests that the returns in the long run might be more modest. In fact, before dividends, the return over the next years based on that indicator should be around zero. Now, that doesn't mean the market can't go up or down many times in the interim. But yes, those higher, what these high markets at the very minimum should do for everybody is to revisit their investment plan, their investment process, which kind of suggests that they should rebalance. The time to prepare for worse times is when times are good. The Wall Street Journal had an article the other day about things people can do, and rebalancing was one. But then it also suggested that, hey, yeah, if you're retired, you can do a reverse mortgage when the market's tank. Well, that's the one step you shouldn't do, because if you haven't rebalanced, then suddenly you have less money. You shouldn't be doubling down then. You should only be, quote unquote, doubling down or consider doubling down if you've put some money on the side. And then, of course, the rest of it depends a bit on one's philosophy. But I think the important thing is to do some stress testing in one's portfolio. And most notably, when things do go down, does one have things in one's portfolio that behaves differently, right? And so in that context, when things move higher, it is all right that not everything goes up in one's portfolio, because that might be just the one thing that helps one cushion the things on the downside. The thing, though, is that historically, volatility in equity markets is much higher than it has been in recent years. And so when we do enter a bear market, people will realize that, oh, maybe they're not sufficiently diversified. Right? You never have enough of the conservative stuff on the way down. David.
Okay, next question comes from Mark Krieger. And the question is, what do you think are the precious metals implications relating to the midterm elections? Axel?
Yeah, so I mentioned a little bit about gold specifically in the context of the rate environment we're in, and I specifically mentioned it in terms of rates rather than the elections, simply because the elections is kind of just one attribute in that game. The one thing that in the election that can happen is that the longer term growth prospects in the US could be repriced. And so the price of precious metals and gold most notably, tends to have a correlation with the 10-year yield, how the sort of return expectations one has on the quote-unquote risk-free asset. If you go to other precious metals, you have much more industrial components, and so from that point of view, there is and of course, if a particular metal might be hit by tariffs, then of course that could create its own sort of dynamics. But it's in that context that one should look at it. Now, again, it is priced in that the Democrats are likely to win the House right now. And so, of course, if you have some sort of landslide movement in one way or the other, you can see stronger moves. But independent of what happens, these inflationary seeds have been put in. And by the way, when let's say this, we cause gridlock in the midterm election, whichever way you may want to define it, that usually locks in the status quo. Now, obviously, you have a president that is very strong on the executive action side, then maybe you get some actions anyway. But if let's say we do get impeachment proceedings, it may well be that the executive branch gets very much distracted and has less time for executive action. And we have seen a lot of the agenda already being implemented. And so from that point of view, I don't really foresee a radical change with the midterm election. Now, that doesn't mean the markets won't move. We are moving forward. After the midterm election, we'll be looking forward to the 2020 election. And by the way, this will be the end of this year then, pretty soon coming up. And then people will start thinking about next year. And so right now, for this year and next, we have this number here where we say there's going to be less than 6 rate hikes being priced in. So that means if we get one tomorrow and we get one in December, they have fewer than 2 rate hikes being priced in for next year. To me, that's ludicrous unless we have some sort of shock to the economy. I happen to think rates are going to be higher, that we're not just going to go to neutral and the Federal Reserve say, all right, we're happy campers here, now let's see what's going to happen. No, maybe that is the case. I have my money elsewhere right now. And so, yes, so from that point of view, the midterm elections have an impact, but I think it's more the calendar necessarily, because this tight labor market is going to continue, and at some point, the Federal Reserve will have to take that more seriously. David?
Okay, thank you, Axel. And that concludes the Q&A portion of our call. If we were not able to get to your question today, we will get back to you through email should you have any additional questions or comments, and we would like a copy of our presentation slides. Please use the Contact Us section of the website at www.merkinvestments.com, or just let us know right now through your text box. For future webinars, if there's a topic that you're particularly interested in and would like us to cover, please let us know through the comments box. This concludes our call. Have a great day.